All of the following candle formations are reversal patterns. Hammers and hanging men are one candle price reversals and are fairly common on the charts. Hammers are umbrella lines that occur after a price decline. They get their name because they're said to be hammering out a bottom. A hammer is characterized by a candle in which prices slip sharply from the opening price during the course of the trading session, then return close to the high of the candle. A hammer gains greater significance if most of its lower wick falls below a support level like this. That's because the temporary penetration of support means that sellers were unable to keep the price down. Perhaps there was a move afoot to run the stops below support, and then there was no follow-through on the downside, so traders covered their shorts and prices rallied. Hanging men, on the other hand, are umbrellas that develop after a rally. In a sense, the small real body can be compared to the head of a man and the long shadow to his legs dangling down. As with hammers, the shadow should be at least twice the size of the real body, which means that this one meets the standards. However, as the real body grows relative to the lower wick, it loses its validity as a hanging man and gradually becomes a black candle. Hanging men that develop after a prolonged advance should be treated with great respect, especially if the trading range for the hanging day is above the entire trading range for the previous day, as in this example. In bar chart language, the hanging day would be a gap day. The color of either the hanging men or the hammers is not important. For both candles, the necessary characteristics are: first, that the real body should be in the upper end of the trading range. Second, that the lower shadow is at least twice the height of the real body. And finally, there should be nothing or very little in the way of an upper shadow. Generally speaking, these patterns will gain significance the longer the lower shadow, the shorter the upper shadow, and the smaller the real body. Hence the lower shadow should normally be at least twice the size of the real body, and generally it's much greater. Thus in this diagram, example B will, other things being equal, be much more significant than example A on the left. While the color is not too important, a white hammer tends to have more significance than a black one, since it means that the price opens, sells down to the low, and ends on or very close to its high. So let's pretend this is a hammer, and I'll make it into a white one. Similarly, a black candle tends to be more bearish for a hanging man. Patterns have bullish and bearish implications, but they usually require some form of confirmation. For example, if a hanging man is followed by a day in which prices trade higher, then the bearish implications of the pattern are cancelled, or put it another way, not confirmed. On the other hand, if it's followed by a long black candle, the negative implications are confirmed. A generally accepted rule states that the larger the gap between the opening of the post-hanging man candle and the real body of the hanging man, the more likely it is that the hanging man will turn out to be a top. The rationale is that the opening below the real body means that all those people who bought between the opening and closing price of the hanging candle are literally left hanging. An additional confirmation requirement is for the close of the day following the hanging candle to be comfortably below that of the hanging real body, which it certainly is in this diagram. It's also important to look at prior price action and other technical factors, which we'll take a look at when we get to some marketplace examples. Basically, it comes down to the fact that if prices do not run up prior to a hanging day, there is nothing to reverse, so there can be no reversal pattern. The same would be true for a hammer if it's not preceded by a down market. It might appear at first sight that since the price springs back to close well above the session low and nearer to the high during a hanging day, this candle should be bullish. The point seems to be the very fact that the price slips so much during the formation of a hanging day means that the price is vulnerable. If it's then followed in the next session by a weak candle, this just confirms the vulnerability was not a flash in the pan. Here we see a decline halted by an obvious support level. Then a hammer is formed, but the real body of the hammer remains above the support level. Only the lower wick moves below it. This is a very bullish short-term characteristic. What we're seeing is the price slip sharply during the session, but closes at or near to the high. The sell-off represents a bit of a climax. Those who shorted during the session decided to cover as they find that selling pressure is no longer able to push the price any lower. It's more significant if the lower shadow penetrates an important support level. This is because the violation of the support ought to encourage more people to liquidate long positions or go short. When a break of this nature fails to attract such selling, and instead the price rallies towards the high of the session, it indicates the support violation was probably a whipsaw. Since the hammer, by definition, appears after a prolonged decline, this failed downside move represents exhaustion. Confirmation will come the longer the price can hold above the bottom of the lower shadow. Sometimes it experiences a subsequent hammer as the bears once again unsuccessfully press the market lower. In this example, though, only one hammer day was required, since the price soon took off again on the upside. A good hammer represents an emotional extreme, so it's usually a good point under which to place a stop.